this is more of a Q&A. If not, then I will also go over a few things that everyone should be thinking about. If you guys have any questions, this is the right time for you to just ask questions in the chat going forward. Okay, let me answer that first question. It's an extremely important question, and you guys are going to think a little differently after today. The rep status is mostly for people who are starting out and then wants to save taxes. Everyone understands the rep status is the real estate professional status. It helps you offset your W-2, your business income with real estate. And most people want that, right? I'll tell you how to get there for 2025. But in the long run, I want to tell you, you should avoid being a rep status for various reasons. What you want to do is you want to be like wealthy, rich people, like Trump and Biden. Doesn't matter which party you are affiliated with. What they do is, I'm pretty sure you guys know this, right? Trump is a big real estate investor. He's not going there trying to qualify for reps, but he's offsetting his entire taxes with real estate. How is he doing that? He's doing the opposite of what everyone is doing. That's what the wealthy people do. And I want you guys to understand that. You do not want to be like a normal, this is a good way to start. But eventual goal for you guys is to do this. It's going to sound complicated, but I hope you guys can handle this. The whole purpose we have reps is you take your W-2 income, which is non-passive, okay? And then you have your real estate, which is passive. You become reps, make it non-passive, and offset each other. Very simply put together, right? You have a non-passive income, and you have a passive and a losses from real estate with depreciation and cost segregation, which is our next question. You harness all the losses from this area, and that's what the rep status is for, real estate professional status. Now, what rich people do is they do opposite. They don't care about reps. What they do is they will keep this passive. This on the side, passive always. You just buy real estate, give a full management to a property management, move on, go to bigger, better stuff, next stuff. But what they do is they get other passive income. They don't want to do W-2 income anymore. As you're wealthy, your W-2 income drops, right? They want to invest in other deals. They want to start a business with a friend and become passive in the business. You open a restaurant, you just give them money, you're passive. You can get involved to some extent because there's some hour requirement you have to manage. You convert your restaurant business to passive, you also invest in real estate and offset each other. So there's no need for reps. You go to the next level. So that's the next level thinking. You guys might not be there yet, but something you need to keep in mind as a long-term tax planning. That's exactly what we do. So I'm saying this to you guys. Make sure you will be working, whoever you work with, have a long-term plan in place. Because yes, saving $100,000 in taxes with rep status right now is amazing. You should do so. What are you going to do with $100,000? Go invest that in other businesses, get another $100,000 of passive income, and then don't worry about the reps going forward. Exact same tax saving without the reps, without the audit risk, without all these court cases, because it's extremely in the audit. And the IRS does not like when you have reps status. So I want to put that background information before talking about this rep status. You're already qualifying for reps in 2024. For 2025, you're looking to buy a business. So if you have a business related to real estate, then you already qualify as reps, right? If you're an agent, you're buying a business, you're a wholesaler, you're a flipper, you will be reps no matter what. But if you're buying a normal restaurant or if you're buying other non-real estate trader business, then you have to follow the hour requirement. The rules for reps is two-prong test, right? The first prong is if you have no other jobs, no other business, then you have to work at least 750 hours in a real estate trader business that you actually materially participate. But if you have other jobs or other businesses, then you have to at least work as much and 1 hour more, right? More than 50% has to be in real estate. Meaning, if you have a part-time job or business that you're going to open, if you're going to work 1,000 hours there, you have to work at least 1,000 hours and 1 hour more in real estate. That's how you're going to maintain your rep status. But if you already had a reps in 2024 and you have got losses and it's carrying over, you don't have to be reps in 2024 to use those carryover losses. Yes, you can meet the rep status even in 2024 if you follow that rule I just said. Two-prong test. You always have to have 70 hours. But if you have other jobs and businesses, just make sure you have at least more than 50% of more than this needs to be in the real estate business. That's how you're going to maintain your rep status. There are a lot of trackers and new apps going forward. You can track your hours. be detailed. Okay, some of the I had to went through some audit for short-term rental loophole this year. They did not find anything. They were fighting a bunch of other things. So I defended everything, and at the end, what they're fighting is your hours are, and they had 1,200 hours. They had 1,200 hours. I asked for 500 hours, saying I don't trust you. So please make sure your hour tracking is supported by your receipts. If you're going to Home Depot, if you're meeting invite, have a calendar link there saved. If you took some action items after your meetings, please make sure you write it down, document this. I had this meeting with my tenants. If there's nothing to prove, there's no text message, nothing. Okay, I had a meeting with tenant and I did this based on the request. Be as detailed as possible, and you will be fine. But that's how you meet the real estate professional status, even in the year when you have a business. You just have to meet the hour requirement. Is that as simple as that? It's very bright line test. But what is not clear is that it's the hour, right? What IRS might come back and slash some hours. You're not, so make sure you're not on the edge. If you need 1,000 hours, make sure you have 1,200 hours, because they might come and slash some hours. Before I move on to the next topic, last thing I do want to tell you is manage your hours. If you have another business, if you're going to start a business, especially what you can do is you can talk to your partners and stuff, saying, hey, this year I want to spend only 750 hours or less than that, because you have to get 750 hours anyway in the real estate to qualify as reps. But if you get anything more than 750 in of the business, then you have to also match that with real estate, which you don't want, right? More hours, more issues. So talk to your partner saying, can I spend less time, or can you hire someone else to do your job, virtual assistants, and do other things, so you don't spend that much hours. Let's move on to the next question, which is people want us to cover cost segregation and what limitations are there against W-2 income. Yes, there are limitations. If you're a business owner, if you make $10 million or $100 million, you can use real estate to offset everything. There's no limitation. However, if you have a W-2 employee, or if you have an interest in dividends, or if you have a capital gain from selling a big asset or your company, that capital gain, or not a business income, that is limited to, for married filing jointly, you can only offset up to 600, let's say on average $650,000. It's still a significant amount of income to offset, and most people don't even, like most of a W-2 employee will not, most will not even hit that threshold anyway. But it's limited to $600,000. So that's the limitation you have. It's called excess business loss limitation. If you're a W-2 employee and you can go buy a $100 million apartment, you cannot offset more than $600,000 around, okay, 650. So when you work with your tax planner, they will give you the details on, hey, this is what I'm going to do. This is your maximum you need to invest to maximize your tax savings. You don't need to go more than that. They'll give you that. So understand those thresholds before going and buying real estate now and in the future. Okay, that's the limitation of W-2 income. You'll be rest for the first time, but you're also asking, is there any limitation of W-2 income? So I want you to understand what the limitation I just put together is. Not just real estate. Ignore real estate right now. You are just a normal W-2 employee. You make $800,000 from Facebook. And then you open up a business, restaurant, and it gives you $1 million loss. $1 million is also limited. It's not just real estate. You can only offset up to $600,000 of your Facebook income from that $1 million loss. So that $1 million loss can come from real estate, restaurants, a food truck business, whatever you do. The excess business loss limitation applies to everything and everywhere else. Real estate just happens to be one of them. Losses generating business. So that's the limitation. Even if you're doing reps, doesn't matter. Even if you're doing a short-term rental loophole, does not matter. Your losses are limited to $600,000. If you're a doctor, if you have option to go 1099 versus be a full-time employee, you should think about that, because going 1099 converts your income to a business income, and you can offset the entire thing. Just so you know. Okay.
He's not participating in any other business, just managing rental properties, not an employee, retired. W-2 income of $500K would still get the full deduction from cost seg.
The W-2 income is from the buyer of the business and industry. Yeah. And the other one is I'm not participating in any business, just managing real estate, not employee any longer. Makes sense. And the other one is the limit is 650. when the business is bought out, it will be still, if it's coming under your W-2 income, doesn't matter. If it's a capital gain, doesn't matter. It's still the same limit, $650,000. But you should work with your advisor. There might be a way, even with real estate, to bypass that limitation. That's a little more complicated to talk on this call. It depends on so many other situations of your situation, which I do not know about. So it would be worthless to bring that up. So talk to your tax advisor on, is there a way to bypass that limitation, even though you have W-2 income of the 650? Sometimes there is, depending on how you run your rentals and what you do. Property management, you already qualify as reps. You're right. Qualifying as reps, and then doing a right kind of cost segregation, understanding your threshold, and harnessing that loss from a good real estate purchase to offset your W-2 income or buyout or capital gain is limited to around $650,000. In the highest tax bracket, that's a significant amount of tax savings. We're talking about $200,000 of tax savings, $200,000 of tax savings, not deduction. You actually get $200,000 back from IRS. That's extremely high amount of tax savings, even with $600,000 threshold. But like I said, if there's a way in the future, whoever's listening to this, right? If there's a way for you to, if you always want to be in real estate, always make sure if there's a way for you to go ahead and convert your W-2 to a 1099, you should do that. That would help you not be under any limitation, and you can offset the entire thing.
There's a couple of questions in the Q&A section too.
Okay.
Does your tax planning service include applying recommended techniques or just advising? And we need to find someone to get them implemented.
People don't understand what tax plannings are because most CPA firms don't even offer that, right? Tax planning is we give you an action items. Okay, hey, this is one of the things you're going to do, and these are the rules. This is the deadline. We're going to explain you the video. You're going to have a call with your CPAs, and they will answer all your questions. So we help you implement that. You're the one who say, if we tell you, hey, let's say go and hire your kid, we'll give you all the details, how much to pay them, how to run your payroll, everything. We give you all the information. You still have to go run the payroll. We can do that on your behalf. So implementation, when you say a final piece still remains with you, but you don't have to go find another CPA to implement it. We give you all the details to implement. I know there are some firms will just give you a list on all the tax planning and then go on your own and charge you thousands of dollars. We don't do that. We hold your hand, answer your questions and everything to make sure that you are following. Let me give you something more information on this one. Tax planning is complicated business. Okay, it's extremely knowledge driven. Most CPA firms cannot handle it because you have to like taxes to advise other people, and most CPA firms will just crunch your numbers and move on. And you have seen this before, and I think 90% of firms do that, which is fine. Now, we as a firm, we are developing a tax planning software this year, which is let's say someone comes and you put in, I make $650,000 of W-2 income. What can I do to save taxes? It will give you everything, meaning it will give you deadline, action items, contracts, and do hire key stuff by an AI-driven modules to actually implement a tax planning software. It's going to probably launch by the end of the year. So follow us on social media and everything so you can be up to date on that progress. But that's like working with the CPA, but better CPA, to be honest with you, because most CPA cannot do this. And we are backing it up, meaning we are developing it. And you'll see that in our social media in this year. I have another question. It says, cost segregation varies from 900 to 8,000. All audit support. Any reason I should go with 8,000 versus 901? Yeah, I'll explain that to you. Should you use $800 cost segregation or $3,000 cost segregation or $9,000 cost segregation? Depends on what kind of assets, what you're trying to do, and so many other things. Understand the risk and then choose wisely. When you have a big commercial property, doctor's office, warehouses with equipment that you can't even pronounce, then yeah, you're gonna have an engineering firm go and do all the cost segregation. They might charge you, and I have paid like $20,000 for cost segregation report. Depends on asset class. If you're just buying a short-term rental, a long-term rental, a single-family house, no, most of these cost segregation firms are just doing this virtual anyway. They look at Zillow, they look at Google Maps, they'll come with all the square feet, and they will give you a virtual report. Now, understand if you're gonna do like complicated assets, go with the more expensive one who can defend you. But the cost segregation report for the single family house, understand the risk. There's online DIY tools, right? You can go and do this on your own. And this, it gives you a report that says your furniture is worth $10,000. It gives you that information. And then you go file a tax return. And IRS looks at it and says, and comes back to you and says, hey, Ashish, you said $10,000 for furniture. We disagree. It's only $8,000. You need to go pay us back those taxes. And they'll go and look at the report, and the $2,000 deduction that just got denied might be $100 in extra tax. So is it worth paying $8,000 for the $200 risk, or is it worth just going with the cheaper one, especially depending on the asset class? So understand that risk. Again, if you want to sleep better at night, then maybe find something in between, right? Don't go with the cheapest one. So even the cheapest one can provide some kind of audit support. So go with and make your decision that way. See, most of the single family house do not need expensive cost segregation. You can just use the cheaper ones, just so you know. So someone asked me, are you mostly CPA sort of planner or tax legal consultant? What would you say to pros and cons of engaging with either both services? Would you use legal tax team versus an accounting team? Remember, so I know, I'm so in this business, so it's a very simple question for me, but most people don't understand what they need. When you start a business, there are three main aspect of your business that really needs to be done: accounting, taxes, and legal. Legal is event-driven engagement, right? You might need a legal help when you're trying to set up all the entities. You need legal help when you're trying to sign a contract. You need legal help when you're trying to finalize, someone sues you or you're trying to sue someone. You don't need them on your team all the time. Legal teams are expensive. Normally, what you need is a bookkeeper and a tax accountant. And some firms do the same thing. We do tax planning and tax returns right now, but what you need is a accounting team who does your bookkeeping and then does your taxes and helps you with tax planning. There's no when it says tax legal consultant, yeah, they're tax attorneys, but they just deal with the court cases and stuff. They're not your normal CPAs. They won't do your bookkeeping. Okay, you need to work with CPAs who is practicing like tax and accounting day to day, not tax attorney in general. Most people get confused. There's one reason, and here's the reason. During our tax planning, we give a detailed entity structuring, like a legal entity structuring. And what I mean by that, I think this might be helpful for you to get. I'm going to share my screen really quick here and see if you guys can see. I will walk people through the legal structuring. And let me just show you this. We'll go to people in here, and then we'll drop their current legal entity structuring. Remember, CPAs cannot legally create your entity structuring. We're not attorneys, lawyers, but we will walk you through all the details, how to file, what you need to do, what kind of entity you need. We'll drop the entity structure for you like this. Okay, for your rental, your partnerships, and then if you're going to do syndications, GPs, and fund, how you structure all of those, your land trust, we give you everything, and you take this and do your own tax planning, or you will work with an attorney if you want to work with an attorney. But that's where the attorney is needed. And in our tax planning, we kind of draw that for you, because if you go without that to your tax attorney, they will also draw the same thing and they'll charge you $5,000. That's already included on our planning services, so that you guys don't have to double pay. Because most of the attorneys will not be CPAs, will not know the taxes, and they will create bunch of partnerships which requires $2,000, $3,000 to file every year, which you don't even need. So always make sure you work with the CPAs before finalizing your legal structure. Anyways, I'm going to move to the next one. How do I ensure my material participation log is IRS proof? I'll tell you, very simple. And what they need is, we give you the detail. Once we get engaged, we'll give you how to track your hours. We'll give you a tracker. We'll give you examples, and then we'll give you detail and instruction of what counts, what doesn't count. Right? Not everything counts. Those are investor level hours that do not count. Your hour has to be material and significant and continuous. Also, it has to be like operational level hours. So we give you that detail, and you use that to track it. You will track more than what you need. And then we will review. If we're engaged, we will review and give you some suggestion. But the basic suggestion is this: be as detailed as possible, in and out. This is what I did. I met with my tenants. My tenant's name is this. We went to Starbucks and had a good moment. Right now, yeah, the better you can describe the event, there's a lot of abuses here. And by design, IRS is very skeptical on this one. So you cannot prove out every single event. I understand. You cannot say, I went to Amazon and did 3 hour research on to how to buy furniture. Can you spend 3 hours in buying furniture? Yes, absolutely. You can spend 3 hours. But if you have recorded 1,000 hours and none of those 1,000 hours are supported by events, which could be supported, like events or travel, or if you go to Home Depot, could be supported by your receipts. If you cannot support that and you go and put 5 hours on Amazon, the Amazon also gets slashed. But if you have supported 80% of it in a very detailed record, and if you have some one-off items which cannot be supported, it's subjective, then IRS will work with you. You know what? You are pretty decent on other things. This will be fine. You have to understand that, okay? When this client who had a short-term rental and then lives another 3 or 4 hours away, right? And he orders these furnitures to for his short-term rental delivered to his primary residence to put in a truck and drove to the short-term rental and set it up. When he was audited, they denied the deduction for furniture stuff because it was not delivered to a rental property. It was delivered to his primary residence. So please make sure you document everything you could possibly document.
Can I leverage the CPA here for advice on business acquisition?
Yeah, we do. We business buying and selling business, you have to be careful on as well. Asset class allocation. When you buy a business, don't buy stocks. Do not buy partnership interest. You buy an asset. It has to be asset purchase, meaning you can write off those assets. If you buy a restaurant, go and buy, and I'm pretty sure it's going to run as the S corporation. Don't buy S corporation. You have no tax benefit if you do so. Go buy an asset, meaning buy furniture, buy equipment, buy tables, right? Stove. You can write off everything. It's like buying real estate. So you have to be careful how you do that. Lots of other things you got to talk with the CPA to and figure out what you're doing. I also saw the question on the top. Can you explain the 600K limit? If I don't qualify for reps in 2025, but my business has some losses, can they be used to? Yes, you can. Remember, doesn't matter where the losses are coming from. I'm going to go a little more detail so you guys understand how this works. The tax savings in general comes from you have income here, right? W2 or any kind of income, interest, dividend, income here, $100,000. We want losses at any other businesses that can offset them so you can save taxes. So losses helps you not pay taxes on that income, because what IRS is thinking is, oh, this poor guy made $100,000 here, but he also lost $100,000 in other businesses. So you should not be paying tax. He didn't actually make any money. That's the whole reasoning behind it. Now, what you asked me is, can you use these losses from your normal business, not real estate, to offset that? Yes. What's the only requirement is they both have to be non-passive, like a short-term rental loophole. Meaning you cannot be, making $1 million here and go buy a restaurant, be passive, do nothing, like doctors, put money there, and then get $1 million loss from that and offset each other. Listen, you cannot do that. That's the whole reason this rep status, passive activity loss rules were implemented in 1986. Because what was happening before, we were clients, we had people. Once people make millions of dollars and then go buy businesses just like you're doing and invest with their friends and families, do nothing. Just give them money, get a K1 from partnership, their share of income and loss, and get this huge loss because of first year you can write off the assets and in a startup cost, right? Huge loss. And they're offsetting $1 million with this passive investment and said paying zero taxes. That's why they implemented this passive activity loss rule, which means that both businesses have to be in the same character. Either both have to be passive or both have to be non-passive. That's where all this short-term rental rep status comes into play, what we've been talking about. Your losses from your business to offset your W2, yes, but make sure both of them have non-passive, meaning you have to materially participate in that business you're buying. And the 500 hours is the golden hours rule for a material participation. I'm not going to go into that right now. And 600K limitations still apply. So you have $1 million W2 from your spouse, and you get $1 million loss from your restaurant business or whatever business you're buying. The losses can only offset up to $650,000 your highest marginal tax rate. Again, still it's significant tax rate, but there's a limitation. So the question is, we purchased out-of-state property long-term rental in 2024, and you, as a spouse, work a full-time property manager while your husband makes a W2 job income. Will the IRS accept the Excel file to track your property management hour, or do you have any recommendation of tracking hours? How you track doesn't really matter. Like I said, be as detailed. There are some apps and stuff you can implement. I can send you some links. You can sign up for those apps. To be honest with you, can see that the new app that we have going on. We can recommend people to those apps. I think it looks pretty good. You can track those hours. I think you can take pictures of your receipts. Everything is systematic. Find a way to systemize that so you're not missing the hours. But what's the most recommended method? Doesn't really matter. Most of people do it in Excel because there were no apps and stuff before. Now we have two apps from what I know. One is called Reps Tracker. You use them if you want. So what you track is important rather than how you track it. You can create your own, track by individual property, track by both spouses. Your spouse participation also counts for mutual participation. Track your hours, find a way that's easiest for you to be as detailed as possible. As a property man, remember, if you manage your own property, you don't have to even have a property management, right? You're managing your own property. It's as an operational rental investor. Then yes, those hour counts. Just make sure you're tracking it correctly. Someone asked, what are the best tax saving strategies for 2025? That's a very broad question, but I'm going to break it down because we want to focus on what matters the most. Everyone is asking about real estate and this business. Remember, this is why real estate is powerful. I just told you earlier, and I'm going to repeat this so this sticks with you guys. And I told you, if you lose $100,000 in business, you can use those losses to offset W-2 income, pay zero taxes. Now, before I answer on what's the best tax saving strategies, I want to explain why this matters. I can, let's say I can make $200,000, $300,000, $400,000 from W-2 or any other business I have. Then I can go buy a restaurant, lose $200,000, $300,000 every single year because there's no customers, COVID. I'm a bad business person, and use that losses every single year to offset the income and pay zero taxes. Is that a good tax saving strategies? That's what most CPAs will tell you. Go talk to a CPA saying, what can I do this year to save taxes? They will say, go spend more money. Your business is making $200,000. Go buy laptops, go buy vehicles, go buy jewelry and try to write them off. Can you save taxes? Yes, but you're also losing the money there, right? You're actually losing money to save 37 cents on a dollar because that's the highest tax bracket you have at the federal level. So you have to lose $1 to save $37 in taxes. That's one of the worst investment decisions you'd ever make. So why real estate is different is same scenario, rather than a restaurant where you're losing $200,000 a year, replace that with real estate. You buy real estate first. First of all, you put a minimum down payment, or you do seller financing, creative financing, so you're not out of pocket for your money, right? And then banks finances most of them, right? Banks giving you 90%, 80% of loans. So you're taking banks' money to do cost segregation, have this depreciation, which is not actual loss. It's just a paper loss. You're not losing the money to offset up your income. That's why rich people invest in real estate. They have $100 million of income from other businesses. They go buy $1 million and $1 billion of real estate and offset the income without actually losing money because real estate is highly lobbied to make this happen for rich people. We just need to tack in with them and they're doing the same thing for us, right? Now, the good news about real estate is, like I said, you're not losing the money, you're depreciating asset and saving taxes while the property actually appreciates. You guys understand this, right? A restaurant, I just give an example, is you lose money, you can never recover that. Real estate, you actually write off the asset, depreciate the asset, what actually asset is appreciating. In the next 20 years, this $1 million property might be $3 million or $4 million. So that's why rich people invest in real estate. So when you ask me what is the best tax saving strategies this year, doesn't matter which year, doesn't matter what kind of depreciation, bonus depreciation you have, it's always real estate. There's not a single other asset that can give you tax savings as real estate. Now, there are other minor things you can do, right? Buying a vehicle when you need one. You can always invest in oil and gas. You can do foreign exchange partnerships. You can do hire your kids. Make sure retirement account is maximized. Those are the bigger things that makes huge impact. Writing off $50 meals is going to save you taxes. Yeah, but at what cost? Should you write that off? Yes, I'm not saying don't write that off. But next point is going to be very important. If you write off your vehicle, if you write off your meals and your seminars, your education, things like that, it affects your DTI, debt to income ratio. You don't want that. If you're going to be, if you want to be long-term real estate investors, especially when you're trying to get this conventional loan in the first few years of investment, don't try to write off everything. You can take your income down to zero with depreciation and cost segregation. That doesn't affect the DTI. But if you try to write off, your meals and your clothes and your watches, then it will affect your DTI, and then you're never going to make progress that you thought you would. So understand that. Okay, understand how to increase your DTI. If you have an S corporation, take the distribution out of the S corporation, because banks will look at your distributions versus net income from S corporations and businesses. So many other things. You have to talk to your advisor who understands real estate to make sure that this happens. But so to wrap this question up, you asked me what is the best tax saving strategy for 2025. Is those things I said before, but very simple. Everyone can do this. Understand, what the biggest bang for your bucks and be. And let me give you an example, really, really quick, numbers wise, so you guys make sense. I'm going to share my screen again here. Let me give you an example. Let's say you were working with me. Ignore all the details here, okay? I know it just kind of looks complicated, but I just want you to look at a few things here. Let's say you live in Colorado, and you have two kids, you're married jointly, and you make $200,000 as one spouse, other spouse doesn't even make any money. Very simple, $200,000 return, right? What can this person do to save taxes? What we do is, but these are our tax saving strategies. It tells me here, hey, this person, okay, again, it's all automatic. It says, you can save $6,000 if you would maximize your 401k contribution, which is $23,000. You can save $2,700, $2,200 in your marginal tax bracket if you can maximize SSA and you have real estate. And if you buy $100,000 property, you can save $5,000. If you do $150,000 of QIP, qualified improvement property, with your existing property, then let's say to $39,000 in taxes. Again, I'm not going to go over all of this, right? But what I'm trying to tell you is, this is how you do analysis. I'm going to show you one more thing. Let's talk about real estate, because everyone is interested in real estate, right? We have 200 tax saving strategies. I'm not going to go over all of them, obviously, but let's talk about real estate. This taxpayer, with that an income I just showed you, is going to pay around $34,000 in taxes. So I'm going to slow down because I know it's a lot of information here. So this taxpayer I just showed you is going to pay $34,000 of total taxes to the government by the time his tax return is done. Remember, this is different than your refund or what you're going to have to pay during your tax planning. You have been paying this to the government throughout the year as W-2 withholding, right? Can you get this back from the government, $34,000 check? Yes, let's talk about real estate. I'm not going to assume bonus depreciation comes back, but if it comes back, let's look at the best case scenario for the next few years. If bonus depreciation of 100% comes back, this taxpayer needs to buy maximum amount, okay, not more than this, $700,000 asset. I'm going to put 772. If he pays zero taxes, new tax rate after zero, he gets entire $34,000 as a check from government. Zero taxable income. Everything is reduced to zero. This does not affect your DTI, debt to income ratio. This is a better way to save taxes and buy more properties. That's $700,000 purchase. But let's say you only go and buy $300,000 long-term rental, cash flowing property in Alabama, saves you $17,000 in taxes. That's how you do your analysis. Now, to buy this $300,000 property, you put let's say 10% down. This $30,000 can give you $17,000 tax saving. If you go put that in 401k, this is how we do. Someone's asking me, how do you implement this for our clients? Yes, we give you all this details so you can make your analysis. Okay, let's look at a 401k. If you put that $30,000 down payment into 401k, how much can you save? But this taxpayer can put $23,000 in the 401k and save $6,000. So which one is better? To use the same money and put in real estate, tax savings is almost triple. The return on investment. That's how you do your math. And your CPA will help you do that math. Not everyone. Some CPAs will help you do those, and they're out there. They're rare, but they're out there. And we are converting this to a software, so you can do this on your own next year. If you were to work with someone like us, we can walk you through all these rules. When this software launches next year, you can do your own tax planning, because we charge people a decent amount. Our tax planning starts from $5,000 to go $15,000. When the software launches, you might be running your own tax planning for $800 a year for next 10 years. So whatever you pay for tax planning this year with whoever it is helps you in a long run. Okay, this is not like an investment. I think I have a new question here. So the question is, does IRS audits same year and hold on refund? No. That's a very short-term thinking. I know what you're asking. So you're asking me, I do all these aggressive strategies, rep status, short-term rental loophole, and I'm supposed to get big refund, and I file a return. Are they going to hold a refund? No, they will not. They will. As soon as you file the return, you have to be smart about when you file the return. So I'll give you a piece of advice. We extend all our clients' tax return extension. You file for extension, so we can file a return around somewhere around extension deadline. The reason is this: if you go and file a return right now, January, February, March, April, before the deadline, the original deadline, you're among the very small group of people who file the tax return, simple returns. So your return with huge losses and cost identification becomes the most complicated returns. When that happens, you get audited quicker. But if you wait until Walmart and international companies and complicated tax returns being filed, your returns become simple compared to this complicated tax return. So your chance of getting audited goes down. You have to be smart about that. IRS gives you a way to extend a return without incurring any penalties. But to close out this question, does IRS audit you in the same year? Hold on refund? No. They will issue a refund and then they have 3 years to audit you. If you don't get audited in 3 years, you're fine. You get audited within 3 years, you'll get audited probably in 2 years or maybe a year and a half. It's random too, right? Meaning, they will put you in different buckets and then randomly select you. Next question: is it 500 hours or 750 hours? But then we're talking about two different things. There's a material participation and there's a rep status. Rep status is 750 hours, but you can only count a materially participating activity, which is the 500 hours activity. CPS do not understand this concept, to be honest with you. But to make it very simple is you can only count the hours that you materially participate, which is that 500-hour test. Your spouse's hour also counts for that material participation activity. Now, once the activity is a materially participating activity, then one spouse needs to miss 750 hours to qualify as reps. That's how complicated it is. So it's 750 hours for reps if you want to get a very high-level answer. Next question is, do I need to get property management license to qualify as times against? No. The rep status, material participation is our requirement. You can qualify as reps without any kind of real estate license or property license, even a state, in a county license. Doesn't really matter. License has nothing to do with tax rules. Okay, it's our requirement. How much hour you're logging, how much time you're spending. That's all. Next question. In last call, you said don't put money in Roth 401k. Why? I didn't get it. This is where you got to work with the real estate CPA. Not everyone understands this. I'm going to make it very simple. Everyone understands how retirement accounts work. You have a retirement account. You put money in retirement account, 401k or IRA. It saves you money right now. That's a normal traditional 401ks. Everyone knows this. It's super easy to do. The employer offers that. You can go open up an IRA in your bank account, put whatever the limit is, move on. Simple. But what to choose, Roth or non-Roth, is people don't understand. And it depends on your retirement goals and a lot of other things. I'm strictly talking from tax perspective. If you are a real estate investor, if you put money on the traditional account, not do Roth, that I suggested, you get tax savings right now. Let's say you are in the 37% tax bracket, and you make $1 million for W-2 from Apple. Your husband and spouse both put, let's say, $50,000 in retirement account, which you can right now, and normal 401k, not even business. That's a 37% tax savings on every dollar you put. You put a normal traditional account, and then next few years, when your life changes, next 10 years, one of the spouse quits your job and goes invest in real estate, and then you do cost segregation, and you get a $1 million loss in that year. Then what you can do is you can take this traditional account that you have been saving taxes all along, convert that to Roth. It's called Roth conversion. Take it to the Roth conversion. When you do that Roth conversion, you have all these losses from real estate, can offset the conversion. So you not only save taxes when you contributed during your making a W-2 income phase or a business phase, then you also converted that to Roth for free because you have these losses from real estate. And then when you retire, you can take the money out for free. So there are 3 benefits in one. If you're going to invest in real estate, if you have a plan to be a real estate investor going forward, again, strictly tax, right? Talk to your, you need to bring in other phases of your life and retirement account stuff to integrate your tax planning with your retirement planning and everything. But in general, if you're fairly young, you have a lot. If you plan to work for next 10, 15 years, and you're going to get more into real estate, which is, again, this is the right time, right? We saw the bubble, now it's coming down, so everyone's going to buy in real estate. And that happens, then maybe your spouse, even in 1 year, might quit your job or do part-time job and then qualify as rep status, have $1 million loss. That year you can do Roth conversion. There's no limit on how much you can do, but depending on your loss, and get Roth account for free. We spend a lot of resource and time on social media giving this knowledge out. Follow us. And if something applies to you, reach out to us. We'll help you out. You can schedule a call with us to have free consultation. Everything you need is there. But if you follow any social media, you should be able to get all this information from us. I really appreciate everyone who joined. Taxes are complicated. We're going to do more of this. But we also like sharing this information. That's why you see our social media and all those things. So follow us, get back to us. We're there to help you guys out. Thank you so much, guys. I really appreciate everyone who joined, and we'll catch up again probably next month.